Hi, I'm Stuart Jackson, Senior Analyst at Montgomery Investment Management. Welcome to this week's Video Insight. This week, we take a look at a well-held stock in the retail universe, Woolworths. The company's performance has been poor over the last couple of years as a result of a number of factors, including margin pressure in its core Australian food and liquor division, as well as growing startup losses in its hardware chain, Masters. The company released its interim result last week, which included an estimate of the cost of extracting itself from Masters, a continued deterioration in Australian food and liquor margins, and the board's decision on a new CEO. The food and liquor division is the primary driver of earnings and, more importantly, value for shareholders. There is a lot of operating leverage in food retailing. Operating and gross margins are generally low in the industry, with retailers relying on very high volumes of sales to leverage the relatively fixed cost of operating a store and the distribution system. The key to generating this leverage is increasing the sales per store or unit of area, such as per square metre. Coles and Woolworths typically operate off gross margins in the mid-20s and fixed costs around 20% of sales. The problem is that while gross profit will fall if sales per store or per square metre fall, the fixed costs per store, which are made up of labours, lease costs and other costs, are largely unaffected. To highlight the leverage in the core retailing business, all things being equal, a 5% reduction in sales relative to expectations results in a 20% fall in EBIT based on these metrics. Management guidance implies that EBIT margins in the Australian food and liquor division are expected to fall to around 5.5% in 2016, from over 8% in the prior year on the back of sales growth slowing by around 1.5 percentage points on a like-for-like basis. Coles has progressively improved its offering and competitiveness since 2008 after a prolonged period of underperformance. JP Morgan estimates that in 2008, Woolworths generated over 20% more sales per square metre than Coles. Since then, Coles has closed the gap and is now in line with Woolworths. Over the same period, fixed costs in Woolworths' business would have increased due to inflation and wages growth. This inevitably leads to pressure on margins. Given that its sales per square metre has only fallen to levels in line with Coles, there is still room for further declines given the momentum in the business. One of the drivers of this change has been improved consumer marketing, price positioning, ranging and customer experience within Coles. Coles has been able to capture the consumer's perception of price leadership from Woolworths. In response, Woolworths launched a campaign to cut prices across the store last year. The problem is that while this impacts gross margins and profits immediately, it takes time for consumers to recognise the benefit, given that a typical supermarket carries over 30,000 line items or SKUs. Therefore, even if successful, it will take years for the consumer's price perception of Woolworths to change. In the meantime, the reinvestment in price reduces margins and the recovery in sales volume growth lags the decline in gross margins. Additionally, as Aldi grows its store network, it is eating into the proportion of the traditional customer base of both Coles and Woolworths. Aldi's consumer proposition is simple, and as we have seen in the UK, it is becoming increasingly difficult for an incumbent food retailer to be all things to all customers. This acts as a headwind to any recovery in performance for Woolworths. The days of 8% plus Australian food and liquor margins are a thing of the past. The operating leverage in the business means that if the company cannot restart its sales growth, the risk is that operating leverage in the business results in margins falling considerably further before finding a base. The decision to appoint an internal candidate as the next CEO was an interesting one. The company needs a clean slate. The question is whether an internal candidate can distance themselves sufficiently from the decisions of the past to implement the degree of cultural and mindset change required to stabilise the business and reconnect with customers. Well, that's it for this week. We'll be back next week, and in the meantime, you can follow us on Facebook and Twitter.